I'm your host, Chris Noggle, and welcome to Money School Podcast. Today, we're going to talk about what's happening out there in the markets. We're going to talk about the economy, and we're going to talk about something that's very important. Are we in for the next Great Depression? The signs you're seeing, the things you're seeing in the markets and in the economy, and really in your life, are these signs that the next Great Depression might happen this year or next year? That's what today's topic is going to be about. But before we get into that, let's talk about you. Let's talk about your journey to becoming a rebel banker. That journey begins with knowledge. It begins with your journey into knowledge. And knowledge is everywhere today. It's YouTube, it's podcasts, it's social media. Wherever you're getting your knowledge, that's great. But you know what? The person that said knowledge is power was completely wrong. It's not the knowledge that's power. It's the application of the knowledge that you learn that's the most important thing. Because without the application, the knowledge is completely useless. So I want you to think long and hard about that on your journey to becoming a rebel banker. You have to take action. And I'm going to challenge you. I'm going to give you something for free. I'm going to give you this booklet. This booklet is called Drifting Away from Traditional Car Buying. It shows you how to get all the money back for every single car you ever buy, drive, and own. And the best part about this booklet is it is only 68 pages long of really big type with lots of graphics. Because, hey, if you're a visual learner like I am, you need the graphics. So grab this booklet by going to chrisnoggle.com, scroll down until you see the wealth webinar, and you'll see the little copy of the booklet. Register for the wealth webinar. It is completely free, and you will get a free copy of that booklet. So let's dive into this, because this is a big topic that we're going to hit on a lot of things. And I don't want to go too far over your head with some of this knowledge, but it really is a study of history. The first thing when you're looking at where we're at in an economic cycle is understanding where we came from and understanding what's happened in the past. So I don't expect you to study history like I have, because I have been studying history, I have been studying economics, and I have been studying market patterns for far too long. It's dry, it's boring, but it's important. And what I want to do is just take you back in history a little bit so that you can understand that where we're at today is not some special snowflake time where it's never happened like this before, because it has happened just like this before. Maybe the things were called different names. Maybe they happened in a different order slightly. And maybe they didn't happen in quite as quickly as this did. But you know what? History tells the story of where we're at. And then from history, we can derive conclusions as to where we're at in the cycles. And when I tell you where we're at, it might just scare you, because we're right there, folks. So let's take a trip back in time. I want to kind of read a couple things from an economic white paper, just so you understand some of these dynamics about this economic cycle and what it looked like in the past. So many of you have heard of the 1920s, the Roaring '20s. Now, if you haven't heard about this, it was right before the Great Depression. Things were booming and bustling. Maybe you watched some movies where it talked about this. There's the Leonardo DiCaprio movie. I'm not going to name the name, but you know that one. That was the Roaring '20s. That was followed by the start of the Great Depression. In the Roaring '20s, everybody had money. It started where everybody was doing well. It was the industrial age. There was so much happening, but it ended in a bursting bubble. And that bursting bubble happened very quickly. The first drop was the big one, but then the banks and the big money came in and tried propping the markets up, and they did that. But you know what? The burst happened in 1929. Now, I want all of you to think about one thing. I want you to think about what happened prior to the Roaring '20s. And if any of you remember, there was the Spanish flu, and I believe it was 1918. Does the Spanish flu seem similar to COVID? A little bit. If you really study the Spanish flu, it's very similar. It may not be the same dynamics. It may not be called the same thing, but you know what? The same impact happened. But it was followed by a very strong economic period. Well, look at COVID. Almost 2 years ago, we had the COVID. It shut everything down, much like the Spanish flu. Lots of new rules, lots of shutdowns, lots of people lost their jobs, lots of people had to pivot into what we know as the world today. But it was followed by a very strong economic period. stimulated mostly by government printing. So when we go back and we look at the roaring 20s, a lot of the same things happened. But they were followed by that bubble bursting in a big way. And when it burst, there was a decade of hard times. It was actually longer than a decade, but we'll just call it a decade. And when this whole thing happened, it happened because of high indebtedness. There was lots of debt. How much debt is there today? How many people are rushing out, taking car loans, taking mortgages, borrowing money from lines of credit on home equity lines because they've got equity in their house, which I'm not saying is a bad thing. Get that lazy money out of the rafters. But just think about the times. The government's printing it's not the government printing the money. The Fed and the central banks are printing the money, and then they're giving the money to the government in exchange for debt. The debt are called bonds. The same thing was happening back then. High debt. And the market was discounting this high level of debt because things were good. But there's a breaking point, you see, and that's exactly what happened back then. And one of the other things that happened too back then, there was a lot of money printing and devaluing of the dollar. Does that sound familiar to today? Because in the 1930s, after the Great Depression, that's exactly what the government did. It was followed by very high government stimulus. They were printing lots of money. The debt crisis and the plunge into economic activity led to economic depression, which led to aggressive easing by the Fed. Sound familiar? And consisted of breaking the link to gold. Now, back then, gold and money were tied. They had to break that link, and interest rates hit zero. Does that sound familiar? You remember just a short while ago, the Fed pulled interest rates down to zero to stimulate the economy. They've slowly ticked it up, and we're sitting at about 2. But now the Fed minutes back in December said that the Fed is going to raise rates how many times? Is it 3? Is it 4? Is it 5? Or is it maybe going to be 6? Because they've mentioned all of those. They're going to start raising rates very quickly. Why would the Fed raise rates? Now, most people want to believe today they're going to raise rates simply to curb inflation. And maybe that's a big part of it. But is that the whole story? I don't think so. You see, I think the Fed and the government knows where we're at in the economic cycle, which I'm going to get to. And I think they're preparing for this storm, if you will, what could be the next Great Depression. And to get ready for the next Great Depression, well, they got to get their house in order. And how do they stimulate the economy? Well, how did they do it back in the 1930s? They dropped rates to zero. They printed money. How did they do it in every other recessionary period? They dropped interest rates and they printed money, especially the pandemic. They printed lots of money. They dropped interest rates very quickly. So right now, if rates are only at 2, do you think that is going to be enough powder, enough ammo in the gun to stimulate the economy if it falls again here in 2022 or 2023? I think not. They're going to need to get those rates up a little higher so that when this event happens, when the storm comes, they can pull the lever, drop interest rates, and stimulate the economy again. But you can't stimulate the economy if your rates are super low. Just ask Japan how that worked out. So as we keep going through this, so you understand that these exact same things have happened before in history. But then we go to the 1940s. The economy and the markets were driven by war. If you remember, this is the period of war. Governments around the world borrowed heavily and printed significant amounts of money, stimulating both private sector employment in the support of the war efforts and military employment. I'm just reading off of this white paper. I just want you to understand, are we ready for another war? Well, these things happening right now with Russia and Ukraine, and China's not too far away from this. Could that be some signs that we might be looking at something similar to the 1940s? And while that happened, what did it do? Well, that led into the 1950s. You see, I'm going in 10-year blocks, but I want you to understand that each one of these blocks mark a cycle. And there are 3 basic cycles that we're going to focus on, okay? There's only 3 components to the economy. Number 1, there's production. How much you and I and what we do and what our businesses do to create production. Production is a nice straight line because it is organic growth of the economy. The harder we work, the more our businesses produce, the more production we do, which then grows the economy. But it happens slow. But then that just isn't good enough because the government then stimulates that with credit by printing money. Credit becomes easy. Banks issue loans. The government issues loans. Sounds familiar, right? PPP loans, EDIL loans, bank loans. The government gives the banks money, stimulates the economy, drops rates low. You're seeing the thing. All of this excessive printing leads to excessive debt. So when credit is created, that stimulates the economy and creates cycles. What cycles? Well, there's a short-term debt cycle. We've all lived through these. They are usually 5 to 8 years. More commonly in today's world, because of modern monetary economic theory, they are more like 10 years. So the short-term debt cycle, we've seen them, right? We've lived them, and I'm going to talk about them. But then there's the big one. And what is that? That is the long-term debt cycle. Now, this is the one you need to pay attention to. The long-term debt cycle and the long-term capital cycle are the big cycles we need to really look at, because we all know the short-term cycle. It's the rise, it's the fall, it's the rise, it's the fall. We got that. But what's the long-term cycle? It's anywhere between 75 and 100 years. So if you all do the math, if we start really looking at these times, and I'm going to walk you through a few more time periods just to help you understand how similar all of these time frames are and what the results and the fallouts are. So the long-term debt cycle, if we take it back to the Great Depression, it's been 75 years. That's right. Almost to the T. If we go from 1929, or you could pick 1932, which is more commonly the year that they would use, which is when the government stepped in and started stimulating, and we go to 2022, you will find that we are at about 75 years, which means the long-term debt cycle is coming to an end. Now, I will tell you here, the long-term debt cycle is one that you need to be very concerned about. Short-term debt cycle, yeah, we've been there. Yes, they suck. They're not fun, but we make it through them. But the big one, the long-term debt cycle and the long-term capital cycle, and you could even throw in the technology cycle because that's at an end. All of these signal what I think is next. Now, this is my opinion. I want to be very clear about this. You cannot time the market. I do not have a crystal ball that will time the markets, but I do want you to understand that if we just follow the signs, the cycles, and the patterns, we can very quickly start to see where we're going. So let's continue on. So we started here in the 1940s. It was war, and post-war, it resulted in lots of things. Stocks, bonds, commodities rallied over this period. And commodities rallying were mostly because of the war efforts and feeding the war, I guess would be the best way to say it. They say it in a different way. But I also then want to go to the next one, the 1950s. This is one of my favorite periods of time in history. The 1950s, after 2 decades of depression, I do want you to understand that the depression was still going on well into this period. And then it was followed by war. Most individuals were financially conservative. They didn't want to take risk. They had been through 2 decades of depressions. They were nervous about taking excessive risk. That is not what happens today. Nobody's afraid of risk today because they're saying, oh, my dollar is decreasing because of inflation, so I got to seek higher risk assets like stocks to make any kind of a return. This is a trap, but it's a trap and a psychological play that most people fall into, and it's not your fault. It just seems like it makes sense. But when you look at the big money today, the big money's exiting while everyone else, the little money, the average money, the retail investors are plowing money in. Pay attention, folks. You're not seeing this. You're not looking for the signs. You're buying into FOMO, which is a dangerous proposition. So going into this, the market reflected this by de facto pricing in negative levels of earning growth with very high risk. Very low or negative levels of earning growth. Treasuries are very low. Bonds are very low. The returns in the stock market, although good in the past, are not really that good right now, but people are still plowing money in high risk assets like the S&P 500 and other indexes. There's lots of money plowing into them. And back then, in the post-war recovery of the 1950s, the 10-year bond yield was only 1.9, very similar to where it's at today, folks. And earning yields were nearly 14%. Okay, strong, averaging 4% real growth over the decade. So you can see this post-war recovery, whether you understand it or not, led into the 60s. And this is where the boom was followed by a monetary bust. The first half of the decade was an increasing debt-financed boom, just like today. Debt-financed boom. Today is a debt-financed boom. Government printed $5 trillion, maybe even more. And a lot of that money made its way into the capital markets. A lot of that money made its way into your pockets through stimulus checks, through different programs for stimulating businesses. Pay attention, folks. So in this period of time, from the boom to monetary bust of the 60s, it led to a big paradigm shift. Now, we're not going to get too deep into paradigm shifts, but it ended with the Bretton Woods monetary system. The first half of the market started off discounting slow growth and then fast growth of stocks, did well until 1966. Most everybody looked back on the past 15 years of a great stock market return, and they were very bullish. 15 years of strong markets, and everybody was bullish because, hey, if you got 15 years of a bull market, why would it ever go down, right? Just like today. However, because the debt and economic growth were too fast and inflation was rising like it is today, the Fed monetary policy was tightened. Rising rates, they increased interest rates. The yield curve inverted for the first time since 1929. We're talking about the 60s here, folks, 1966 to be exact. That produced the real inflation-adjusted peak in the stock market. And that hadn't been broken for 20 years. In the second half of the 1960s, debt grew faster than incomes, and inflation started to rise with a growth recession. And then the real recession came at the end of the decade. Near the end of the 1960s, the U.S. balance of payment problems became more clearly manifested in gold reserves. And I'm not going to try to get too much into this. I'm just reading off of this, but I just want you to understand, you see how this happened. Debt, strong market, strong market, strong market, the boom, everybody's plowing money in, and then the bust. I just want you to understand what's going on here. 1970s, low growth and high inflation. Many of you lived through the 70s. I was born in 1977. At the beginning of this decade, there was high levels of indebtedness still, and the balance of payments problems still were there, and a strained gold standard that was abandoned in 1971. As a result, the promise to convert money for gold was broken, and the money was printed. So we don't have the gold standard anymore. We just have fiat money. Back then, they were on the gold standard, but they broke it in 1971. Not that that's important for today, but you can kind of see similarities in some aspects with Bitcoin and how this whole thing is happening. So, there was a big wave of inflation expectations, interest rates from 1970 to 1973. Anyway, that's the 70s. Paul Volcker was appointed in August of 1979, and that set the stage for the coming 1980s decade. The 80s were one of my favorite periods of time in history, not because of the way we dressed, but the 80s were badass. The 80s were high growth. Stockbrokers were crushing it. Inflation was falling. It was called disinflation. The decade started with the markets discounting high inflation and slow growth, yet the decade was categorized by falling inflation and fast growth. This was a great period of time. This is a great time for people that were in the stock market. This was a great time for so many people. But the 1980s, led to the 1990s. And this is where we went from roaring, from the bust to the bursting bubble. So from bust to bursting bubble. This decade, 1990s, I don't like the 90s at all. This decade started off with a recession. Do you remember the Gulf War? That's right. We were in a recession at that point. You don't hear about this one very often because it was combated by a war. We had a war going on, and a pretty big one. Remember that? So it was a big war in the Gulf, and that resulted in monetary policy, fast debt finance growth, rising stock prices, and it ended when? Do you remember this? The 1990s was the war. They were printing money. Prices of stocks were going up like they were in the 80s. But then what happened? The dot-com bubble. You see, this is an interesting period because this is where I really started to see things. I'd never known up to this point because I was a young man, pro snowboarder. I'd never really understood what a recession was. But when the early recession happened, the early signs, the planes hit the tower, it was a crazy time. People were making a ton of money. I remember watching the Super Bowl, and I didn't even know any of the companies in the commercials. They were all tech companies. And the decade was the most like the 1920s. So the roaring, the 90s and into the early 2000s was a lot like the 1920s, the roaring 20s, with a big debt bubble leading to so I want you to understand. So through the early 2000s, this period was very much like the roaring 20s, but it ended. So first we had the dot-com crash. Okay. Then we came out of that. And then after that, we had lots of printing. If you remember the dot-com, lots of printing of money, stocks started going up. And then all of a sudden, what? Well, the shift happened. The paradigm shift happened. And we all remember this one, at least I hope you do, the Great Recession. The Great Recession of 2008 and 9. That's right. This was almost a complete collapse of the financial system. You have to pay attention to that. The quantitative easing began. Interest rates were held at near zero. Signs everywhere. Signs. The decade started with high discounted growth, expensive stocks during the dot-com bubble, and was followed by the lowest real growth rate of any of these 9 decades of 1.8. Now, you may not understand this, but I just want you to parallel this period as close to the roaring 20s as it could possibly get. And the results of the stocks had the worst returns in since the decade of the 1930s. This is the Great Recession. So here we are, 2010 to now. Reflation is what they call it in this white paper. The shift to a new paradigm, which was also the bottom in the markets and the economy, which came because of the Great Recession. So we had the Great Recession, which was 2008, and then it's just been going. Then we had the COVID drop, right? About 34%. And then it's been a hockey stick ever since. So I want you to pay attention to this. I am going to read this, and it might bore you, but it's very important. Came in the late 2008, early 2009, when risk premiums were extremely high, interest rates hit zero, and the central banks began aggressive quantitative easing, which is printing money and buying financial assets. Investors took the money that they got from selling their financial assets to the central banks and bought other financial assets, which pushed up the financial asset prices and pushed down risk premium and all asset classes expected returns. As in 1932 to 1937 period, that caused financial asset prices to rise a lot, which benefited those in financial assets relative to those without them, which widened the wealth gap. We have a big wealth gap, the rich and the poor, the haves and the have-nots. At the same time, technological automation and businesses, globalization, production to lower cost countries, China, we started shifting a lot of our production away from the US to other countries. And in doing so, it affected us, it affected our production. And those in the middle and the lower income groups, while more of their income gains over this decade went to companies and higher income earners. Okay, so you're just seeing the beginning of the wealth gap, the haves and the have-nots. It's been widening during this period of time. Growth has been slow, inflation remained low, equities rallied consistently, driven by continued falling discount rates, interest rates from the central bank stimulus. High profit margins, in part from automation, keeping wage growth down. And so that just basically means that the wage growth has been kept down because there's been lots of automation. Until just recently with the pandemic, wage growth has started to go up. And more recently from tax cuts. So there was big tax cuts during this time. Meanwhile, the growing wealth and income gaps helped drive a global increase in populism. Now the asset prices are relatively high. Growth is priced and to remain modestly strong, and inflation is priced to remain low until now. So as we draw a conclusion and we start to just look at these different periods of time, we have to understand that there is a paradigm shift coming. The central banks have been lowering interest rates and doing quantitative easing for quite some time since this pandemic. And in doing so, asset prices have spiked. If you were looking at this chart, these prices have widened tremendously. Interest rates to the monetary. These are all just different charts. I'm just reading them, but here's the deal. The coming paradigm shift. There's a saying in the markets, he who lives by the crystal ball is destined to eat glass. Okay, what does that mean? You can't time the markets. Well, I'm not sure exactly when and how the paradigm shift will occur. I will share my thoughts. This is one of the leading hedge fund companies in the world. This is a white paper that you would probably never read, or even if you did, you may not understand it, but I do. So I'm trying to parallel that back to where we're at today. But listen, I think that it is highly likely that sometime in the next few years, and I want to be clear, this white paper was written over a year ago, sometime in the next few years, number one, the central banks will run out of stimulant to boost the markets and the economy when the economy is weak. The economy right now is weak. It really is. It's delicate. It's a fragile little thing. And what just happened? You just saw the government try to push through another stimulus called the infrastructure package, right? And it didn't go through. $3 to $5 trillion it was supposed to go through, never made it through. Check, sign. Okay, number two, there will be an enormous amount of debt and non-debt liabilities, pensions and healthcare that will increasingly become due and won't be able to be funded with assets. Said differently, I think that the paradigm that we are in will most likely end when real interest rate returns are pushed so low that investors holding the debt won't want to hold it and will start to move into something that they think is better. Okay, people that own bonds, people that have money in banks, people that have money in CDs or money markets, or people that own treasuries are moving all of that money into higher risk asset classes and have been since the start of the pandemic, because the low interest rate environment makes it hard and makes it difficult for people to want to hold those debts. So they seek higher returns in riskier assets. We've already talked about that in prior periods, in prior decades, and you understand where that went. And B, simultaneously, the large need for money to fund liabilities will contribute to the big squeeze. The big squeeze. You may not know this, but the pensions and the Medicare and all these things on the government relate to GDP. And there's charts in here that explain it. We are at about 1,100%. The government's liabilities are about 1,100% of the GDP. So what does that mean? Do the math. For every dollar the government brings in GDP, 1,100% more goes out in funded liabilities. They just can't sustain that. That's going to result in the big squeeze. And in doing the big squeeze, at that point, there won't be enough money to meet the needs for it. So there will have to be some combination of large deficits that are monetized, currency depreciations. Are you not seeing your dollar go down in value? Yes, you are. It is by design, because you're hearing this right here. In large tax increases, tax the rich. Your taxes are going up, rich or poor. It doesn't matter, because inflation is a hidden tax. So your taxes are going up. Listen, this was written prior to what's happening today. So pay attention. And these circumstances will likely increase the conflicts between the capitalists, which are the haves, and the socialists, which are the have-nots, the people with money and the people without money. Most likely during this time, holders of debt will receive very low or negative nominal or real returns in currencies that are weakening, which will be the de facto and will be the wealth tax. You've already heard about this. So you can see that. You can see what's happening. And in here, it goes on to even talk about this even further. And there's charts that explain all those private debts and how the enormous amount of debts can't be met by the GDP. So that will pose problems. And I could keep going and going, but let's just bring this down to kind of where we're at. Folks, if you look at history and you study, and I only went back to 1920s, but I've studied back to the 1500s. I have a chart over here that brings me back to the 1500s. And if you really look at that, you can then start to see where we're going. And folks, I hate to say it, but we very well may be close to what I call the storm, but would be the next Great Depression, because you're seeing all the signs. Russia, Ukraine, incredibly low interest rates. The Fed now increasing interest rates, which will stall the economy, which will stall the markets, which will then put the brakes on and drive us into the next phase, disinflation. I don't think the problem in the future is so much going to be inflation, although it is a problem today. I think the problem in the future is more so going to be deflation. Look it up, folks. All I'm telling you with this podcast is now is the time to get ready. It is the time to plan for the storm. We just got 36 inches of snow here in Buffalo. And you know what? Before the storm came, everybody was rushing out, making sure that they had shovels, making sure that they had salt, making sure that their plow guy or their plow woman were called so that their driveways would get plowed. They stocked up on food. They stocked up on water. This is just a normal thing here in Buffalo when we know there's a storm or a blizzard coming. Well, the storm and the blizzard might not drop snow on you, but the storm that's coming is already here. The storm that's coming is in the financial markets. The storm that's coming is due to the long-term debt cycle and the long-term capital cycle coming to an end, as well as the short-term cycle coming and gone. You know, that cycle is already way past, and they've been printing money to kind of keep us from falling off the cliff. But here we are, folks. The Fed has already said it. They're going to raise interest rates. Not only that, they're going to unwind the balance sheet. They're going to slow down and taper the bond purchases. They purchase, I believe it's about 19 billion, or I might even have it wrong, 19 billion a month in bonds. They're going to taper that, which means they're going to slow that down to stop it eventually. And then when they do that, they're going to start selling bonds in the open market, which is going to be like sucking all the liquidity out of the market, similar to the Spaceballs movie where the maid put the vacuum cleaner on Earth and sucked the liquidity out of Earth. Here we are, folks. Are you ready? Because this is the time where greed isn't good. If you've watched Wall Street, he said, greed is good. This is not the time to be greedy. And my cat right here, who's our shop cat, his name is Cash. We call him Lazy Cash. This is the time to pull back on greed. This is the time to be fearful. This is the time to be patient. This is the time to plan. And this is the time to make sure that you protect your financial house. So folks, I hope this was beneficial. I know it was a bit over some people's heads, but I'm just trying to take you back into history to understand a little bit about what I know so that you then can make a conclusion as to what you should be doing. Look at your 401k. Look at your investments. How much risk are you taking? And does the risk justify the reward? No, it does not. We are seeing major volatility in the markets. Up, down one day, 1,000 points, finished by 90 plus points. Down one day by 800 points, finishes just about neutral. What's today going to be? Is it going to be up? Is it going to be down? It's crazy volatility. You don't want this. Asset bubbles are getting ready to pop. And when it happens, you want to be on the right side of that coin. So stay tuned. I'll be doing a lot more on this so that you know what to do. But now is the time. So folks, I hope you enjoyed this episode of the Money School podcast. We'll see you on the next one.